Welcome back to Market on Close. Michelle Gibley joins us for an international discussion into the bell. She's the Director of International Research at Charles Schwab. Good afternoon, Michelle. Great to see you.
Good to see you.
Let's talk some Bank of Japan. Feels like that's kind of still one of the highlights, but maybe dwindling in its impact?
Well, the Bank of Japan met last night. They kept rates unchanged. Of course, we're thinking back to the last Bank of Japan meeting where, a hawkish hike combined with really, kind of a perfect storm of some weaker U.S. data. We had the weak U.S. jobs data and ISM manufacturings like right the day after. And then also just really extreme positioning on yen shorts caused the unwinding of the yen carry trades. This time, a little change because we've had a really big change since then. The Fed starting is really kind of a key thing. And in fact, expectations for the Fed really has had a bigger impact on the yen than the Bank of Japan. It might be a little surprising. And the reason is that if we look at the difference between US and Japanese yields, it continues to narrow. And that's really been driven by a decline in US yields. The US 2-year yield down 114 basis points since the yen hit a 38-year low on July 3rd. But the Japanese 2-year yield is up just 1 basis point. The big change has really been the Fed. Bank of Japan last night kept rates unchanged. They signal kind of some hawkish commentary in that a hike in October is probably unlikely because the strength in the yen has kind of reduced the need to hike and reduce the upside on CPI in the near term.
I think it's kind of a sneaky, a really good point about the difference between what's happened in the 2 years between us and Japan. Because when the yen was blowing up, you had a lot of people generally talking about it like it was coming from the Japanese, like the problem was coming from the Bank of Japan's actions because it was such a seminal, I guess, kind of shift that a lot of people were focused on it. But like the actual, it seems, impact of what really kind of pushed people to, have to do what they did or kind of really press the pedal to the floor was the fact that the U.S. is making a giant pivot. Like it kind of seems like people, to some degree, kind of had the causality backwards, Michelle.
Yeah, I think it's really, a combination. The yen had been weak. It just continued to weaken all through the year. And we had this really extreme positioning yen short. And I think the combination of the two, the yen, the Bank of Japan finally, hiking, and in combination with the Fed easing is really the key to the puzzle there.
Doesn't happen if the Fed doesn't do what they're doing, which is cutting by more than a lot of people thought they would for this particular meeting, basically. So, one could have argued that some of this is kind of getting priced in along the way. What do you make of the fact then that now that we actually did pull the lever and cut a larger amount of the two options, that the dollar's kind of actually firmed up, the yen has kind of cooled off a little bit? I mean, I feel like people could have argued that if we were going to go 50, the yen would explode out again, but it hasn't.
Yeah, it's the expectations going into the meeting, right?
Yeah.
We had already, like you say, priced in some of that. But I think that you could continue to see dollar weakness just because, yes, the yen has strengthened. But if you look back where it was when the Fed started this rate hike cycle back in March of 2022, dollar yen was at 115.
Mm-hmm.
So it could still have more to go. And the Bank of Japan is not done hiking rates.
Yeah, that's the part too, is they're not done hiking rates. I really think that this is pretty illuminating because it basically means that big yen blow up in August probably was because if you really had to tie a catalyst to it, which I've kind of always suspected, frankly, is that the real catalyst, the first domino, was 2 days before, which was our employment report. That was probably when the market said, okay, the Fed's going to have to go 50. And then now that we actually arrive, the yen's totally calm.
Yeah, the day before that jobs report was a Bank of Japan meeting where they had some really hawkish commentary. So I think it was kind of already setting up under the surface, and then the jobs report just kind of was like the final blow.
Yeah. All right. So the market basically knew 50 was coming for probably a better part of a month and a half, really. So it kind of turns out that in that moment, the emergency cut was fairly correct, basically, that the market priced in, out, and then back in. Pretty amazing. So that's really good context. Thanks for the perspective, Michelle.
All right.
Appreciate that. Michelle Gibley, Director of International Research.